A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they're able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows, and we see like P&G have their own sales room which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来，大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming in to our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco-Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded Eco-Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the Eco-Wave Power conversion unit that has been operating in Jaffa port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the successful wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act for Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn, and he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to a jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon. I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered, for me, the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, you know, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it was a pretty extreme way to treat someone who had spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This is a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And yeah, you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, you know, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray. because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. You know, over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, you know, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commons is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commons decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, you know, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. You know, not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, you know, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there have been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And that whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they've done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, I I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. We're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. We need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving. And most importantly, they've probably gotten off of one before. They've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, HART's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects. And the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform.
I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that You've done a tremendous amount of work, and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. We had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
From New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Here we go for our audience worldwide, live on Bloomberg TV and radio. Good afternoon. Good afternoon. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrell. Your equity market higher, Tom, up by 1.3%. The NASDAQ up by 2.5%.
I have never seen a tape like this, John, into a Fed meeting. Yes, it's a validation, earnings coming out, Apple, Amazon, all the rest of it. But what we see validated in a recession call by the 210 spread is absolutely extraordinary. My guest of this show is Priya Misra. I can't wait to talk to her. She absolutely nailed the first and second derivative of curve inversion. You see it at a 30 basis point inversion.
Right now, negative 30 basis points. She was looking for negative 40. TK, this yield curve, yields on 10s, yields on 2s, they peaked. They peaked the day before the Fed last met on June 14th. And ever since, we've been rolling over.
I agree, and I don't know what Chairman Powell does with it within the press conference. He's not going to give us a data check like we will through the show, but you see it throughout, and that their earnings are doing better. There's a good feeling here that we can somehow get to this, but where's the terminal rate at a 3-ish, 3.25, John, or Anna Wong's stunning 5-ish call above Andrew Hollenhorst at Citigroup?
Well, let's start today. We're looking today for 75 basis points. And Lisa, we're looking for some guidance into September. I've been asking a question over the last month. If we get 75 today, is that the final 75 basis point hike of this rate hiking cycle?
Probably Jay Powell is not going to answer that question. He's going to try to dodge, and basically a lot of people are expecting there to be a hawkish message pushing back against some of the expectation that possibly they will pause in the very near term. Let's just put this into perspective, and I want to just build, John, on what you were saying, that we saw the peak right before the last Fed meeting. Since then, a massive loosening in financial conditions. People are already talking about ending the tapering of the balance sheet. When the balance sheet has barely shrunk, they have barely begun. Rates are not restrictive, and yet people are already predicting the end of this entire program. How does the Fed deal with that?
We saw the peak in yields the day before the last Fed meeting, and we saw the bottom in the NASDAQ the day after the last Fed meeting. Lisa, we've had some weaker data since then as well. Earlier this morning, we had some stronger data, which has led some people to believe that maybe we get a slightly stronger GDP print tomorrow. How do you think they acknowledge? Just highlight some of the recent incoming data we've had on the output side, not inflation.
You know, this is going to be a really tricky needle to thread, because what they can say is they can say, look, there still is strength. Take a look at some of the earnings. Take a look at the durable goods data that we got out earlier today. They are aware that their progress is being made with respect to the tightening in markets, particularly housing. How do they then say, this is a good thing, we want to see the tightening, and we're going to keep it going because there is the resilience in the economy? That's going to be the needle they're going to try to thread.
That will be the focus of the news conference about an hour away. The decision about 25 minutes away. Going into that, here's your price action on the equity market on the S&P, up by 1.3%. On the NASDAQ, we are higher by 2.5%. Tom's talked a lot about yields moving lower. There you go, down 4 basis points on a 10-year. Bramo, 276.30 is your yield right now.
Okay, could I just say that we talked about our 8-hour day, but this is actually one of the most exciting lineups I could ever imagine. We are so privileged to have a number of guests to come on illuminating one of the most important Fed meetings that we've had in a long time. We've got JP Morgan's Michael Feroli and TD Securities' Priya Misra coming up to count us down to that 2 p.m. Fed rate decision. Then we get immediate reaction from Bloomberg Opinion's Mohamed El-Arian, the former chief executive officer of PIMCO, and KPMG's Diane Swank. They're going to give us some insight, and it's so wonderful to hear from people, as we've been saying earlier, John, you were pointing this out, who have gotten it right and pushed against some of the expectations of transitory and the like earlier in the cycle. And finally, some post-Powell commentary from former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg. Really a stellar lineup, Tom. And it's just a privilege, especially at a moment of such uncertainty where the Fed is really dictating so much of the trajectory of risk assets as well as potential economic trajectories.
We welcome all of you on radio and television here, and we are going to adapt and adjust to the research flow that surveillance brings in across all of our Bloomberg terminals. And we do that with Michael Feroli, chief U.S. economist at JP Morgan. He knew coming on camera a front run by Joseph Lupton and Bruce Kasman as well. They have just published, Michael, your colleagues, your global colleagues, a grim note on the global GDP outlook. China, because of COVID, flat on their back. As we go into this press conference, is Chairman Powell the central banker to China? How will he affect the global slowdown Lupton and Kasman see?
No, his mandate is purely domestic, and right now that dual mandate is really a single mandate, and it's inflation. So we're having slowing, particularly in Europe. Obviously, there are signs of slowing here, but right now I don't think those signs are nearly rising to the bar that will get them to dial back the hawkish rhetoric when tomorrow morning we're going to get another hot core PCE and another hot PC inflation number overall, and that's unacceptable. And I think what's happening outside overseas is kind of very secondary.
Michael, the dispersion here of outlooks is extraordinary. How do you define neutrality right now? Are we there at 2 o'clock today? Are we there in September?
So according to the median estimate of the FOMC participants, a 75 basis point hike today would get us to a neutral nominal funds rate. I think neutral is probably a little lower than that. I think the tightening we've seen in financial conditions when terminal is being priced at 3.5 suggests that neutral certainly is low. How much lower than 3.5 it is, it's hard to say, but I think it's probably below the FOMC's 2.5 that they currently have penciled in. Certainly, everything we have seen since the end of the pandemic suggests that trend growth, both here and abroad, remains as weak as it was before the pandemic.
Michael, we're skipping to September 21. Before we get there, we've got 2 more CPI prints, 2 more job reports. Is it too early to expect some weakness to show up in those payrolls reports before we get to September?
I think weakening is certainly possible, but when the 3-month average of payroll growth is 375,000, to expect a negative number before the September print, I think would be kind of an unprecedented slowdown. So I do think we should see things slowing. Certainly, the jobless claim numbers would suggest that. Surveys would suggest that. But I don't think we'll be convinced of recession by the time we get to the September FOMC meeting.
At the same time, there are signs of pretty severe slowdowns, particularly in the housing market. We got additional data today. How does the Fed view this? This is what they want to do, right? They want to tighten financial conditions, but it seems like it's a really bifurcated tightening with a lot of conditions, i.e. the stock market doing okay, whereas other areas like the housing market, where the rank and file individual is trying to buy, is a little bit more tenuous. Is this a good thing for the Fed?
Well, it's a normal thing. I mean, when you tighten policy, interest-sensitive sectors get hit the hardest. The one that gets hit the hardest and the most reliably is the housing market. So that's doing what it should be doing. There's a lot of other parts of the economy that are much more unusual in their behavior right now. Some of that due to the lingering effects of the pandemic, the recovery of the service sector. But I think the housing market is, I think the Fed is probably happy with the slowing that they're seeing there. And I suspect we'll start to see some slowing in manufacturing just given the strength of the dollar. And again, that's another normal effect. That's another interest-sensitive sector.
Yeah.
But a lot of other things aren't behaving as normally as they would in a business
And that's the
cycle.
objective. You said it. Mike Ferroli. Mike, going to be sticking with us going into this decision. Priya Misra is going to join us shortly as well. Lisa, we've said that a few times. The objective was to take some heat out of the housing market, to take some heat out of the labour market, and arguably we're seeing that.
The problem is you're not seeing it really take heat out of the headline CPI number, at least not yet, with peak inflation getting missed and actually seeing yet another peak inflation. So
Sure.
How do they talk about the transmission mechanism of tightening these financial conditions into an inflationary outlook that's really driven by the supply as much as demand?
Yeah, I have to say, monitoring the tone of the conversation over the last month or so. Tom, coming into this meeting, would you have guessed that inflation had a 9 handle?
No,
I would say no. And if you go to the last statement and go to the third paragraph, the last line, the committee is strongly committed to returning inflation to its 2% objective. Given it had a 9 handle last time around, Tom, shouldn't that be the singular thing that shapes the news conference today?
The zeitgeist, John, is we're already moving that direction, 987. My question is, how do we go 765? I'd also note, John, the real yield, it's a property of yours on Friday afternoon, 0.38%, and the real yield. We're not getting back anywhere near a normal nominal and real vista, if you will, that would seem to be normal.
Even for those that think the Fed should pause, maybe even pivot, Lisa, even those people, Ian Shepardson and Pantheon for one, who's expected a wall of economic data to weaken over the coming months, he says today's too early. Wait until September.
And part of the reason why is because if they give a message that they will pause next year, what does that do to markets? It basically gives them a green light to keep rallying if you're at risk and even potentially keep rallying if you're duration. So this just goes right back to where we were before. And
Raise rates more. That's exactly the argument that Bill Ackman put out on Twitter in the last 24 hours. There is a guest coming up shortly that Tom Keene is super excited to speak to. Yes, Priya Misra of TD.
Guest of the day.
Priya came on and we had some slight inversion in the yield curve. She was looking for -40. We're only 10 basis points away now, Tom, at -30.
It's just a superb call of the year. It's absolutely just outstanding call.
Looking forward to catching up with Priya Misra of TD very, very shortly. We are less than 30 minutes to go. We have about 17 minutes and 29 seconds until we get the Fed decision. There you go, Tom, just for you. Live from New York City, this is Bloomberg.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We have the Fed meeting. There's not much of a surprise with respect to what the Fed is going to do.
It's either 75 or 100.
They had the opportunity several weeks ago to go the 100 basis point option, but they quickly swatted that one away.
75 basis point hike is more than priced.
If I take Chair Powell seriously,
The Fed clearly has to fight inflation.
whatever it takes to bring inflation down.
Some of this is messaging.
Whether they like it or not, and whether markets like it or not.
Jerome Powell has made that very clear.
What is going to be far more interesting is what the Fed, what Powell says about what the future path of rates looks like.
Key focus, I think, is going to be on the signaling for the upcoming meetings.
Less forward guidance or more uncertainty.
We're not expecting big forward guidance from the Fed.
We are 15 minutes away from that Fed decision, and here is your price action in the equity market. Good afternoon to you. The S&P 500 positive by 1.3%. The Nasdaq 100 positive by 2.6%. The bottom for the year intraday, the day after on the Nasdaq, after the last Fed meeting. Just think about that, the day after the last Fed meeting. In the bond market, the highs on 2s and 10s the day before the last Fed meeting. So since then, we've been talking about peak Fed hawkishness. We've been fading a lot of that story, and we've been buying into this equity market. Yields on a 10-year now, 276.48. The high of the year, very close to 350. The high of the year on a 2-year, 345. We've come all the way back in, just north of 3%. But we've done much more work on the 10-year, so you've got that inversion led by that drop in a 10-year yield. That's now negative 30 basis points. And our guest in just a moment is looking for maybe negative 40 and a whole lot more. Wanted to check in on euro dollar. The why pretty clear, because the last time the ECB met, they threw in the towel on forward guidance. Euro dollar 101.29. And I wondered, Tom, what that means for the forward guidance from this Fed today as they set us up for September.
John, it's outside baseball, but dollar yen, I want to note, is weaker across the morning, across the arc of the day as well. Yen gave way about 3 hours ago.
TK, the cameraman, has walked away from me, so I'm going to walk away from you as well.
Okay, well, that happens because, it's the afternoon in the morning, and we're like, we're doing a Fed meeting here with some terrific guests. I'm not going to go into the logarithm right now of how you do this chart, but all you need to know is Priya Misra may have the chart of the year. It is the first and second derivative of curve inversion. Priya, we've seen it once, maybe twice in 30 years. Let's start with the why. Why are we seeing the rapidity of curve inversion in 2022?
Thanks for having me. I think it's because the market is pricing in slowing of growth. And the Fed, that's indicating that inflation is much too high, and they have a single mandate right now. And so I think that front end is just going to struggle to price in a lot of cuts. There's a different threshold for the Fed to stop hiking and to start cutting. And so I think that even if we start pricing in the end of the hiking cycle at 3.75 or 4%, as we believe, it's hard to think that the Fed is going to turn on and cut right away. But the long end, that's the safest part out there, because I think growth is going to slow down. Those real rates are very high. And that's where I think investors are flocking, because we're seeing growth slowing down, and this Fed, I think, is responding to realized inflation. And I think that's the issue right now, where the curve will keep inverting in our view.
What does a Misra curve inversion of negative 42 basis points mean to the Toronto Dominion Bank, to the JP Morgan, Michael Feroli's JP Morgan? What does that magnitude of inversion mean to our banks?
So I'm not a bank analyst, but normally inversions are a signal of slowing economic activity in the long end. Over time, it's a function that Fed policy might be too restrictive, and that can slow things down. So, I think it has broader economic implications, certainly negative for financials, because does it mean that the consumer starts to struggle? I think that's what it's reflecting. But the Fed has no choice, really, because inflation is much too high, and they've decided to be not forecast dependent, so they can't actually talk about lags. Because, I think they can't control large parts of inflation, and there are lags in terms of what they do today and when it impacts inflation. But they're responding to realized inflation, and that's why they're going to keep going, and that curve keeps inverting. And I think that means it's a dire economic outlook next year.
Priya, is forward guidance dead when it comes to the Fed as well?
I think so. I think we're so used to it. I think the Fed can't help themselves either. I wish they would just acknowledge that there is no forward guidance. There's an inherent contradiction between being data dependent and giving forward guidance. So I think they should stop giving it. And let just explain the reaction function, and then let the data do the work. Let the market move based on data. Everyone's asking us, will the Fed pivot today? Let the data pivot for the Fed. When inflation starts to decelerate on a month-over-month basis, I think the Fed can slow down. They've reached neutral, so I do think they're going to start to slow down. But, I don't think the end of the hiking cycle is near, because those inflation readings are still much too high. I wish they wouldn't talk about September, because whatever they say, there's a lot of data between now and September. And I think it's kind of pointless to give us that guidance.
Okay.
But
perhaps that's the case, Priya, but they might want to push back against some of the market expectations because it's actually ending up with an easing kind of quality on markets. And I do wonder about all the prognosticators now talking about the Fed stopping the balance sheet roll-off and actually sticking with the $9 trillion on their books as soon as next year, early next year, as a way to sort of temper some of the rate hiking. Do you agree?
No, so I think this is where that threshold question of the reaction function becomes important. They can stop hiking at 4%. We think close to year end, they stop the hiking cycle. And then they wait for inflation to get much closer to 2%, which we only think happens in the second half, before they can respond by easing policy. When they do start to cut rates, I think they're going to stop QT, because it's very hard to be tightening through one tool, the balance sheet, and easing through the other tool. But that's not early next year. I really struggle with the market that's pricing in hikes until December and cuts from February. I mean, that assumes that inflation decelerates or the Fed gives up on inflation. I think they're serious about both sides of the mandate, more so inflation right now.
Priya Misra and Michael Feroli with us on radio and television worldwide. A most important and indeed historic Fed meeting, 9 minutes away, make it 8 minutes away here in a bit to that announcement. Michael Feroli, I want to talk to you about the agony of this politically. Jerome Powell is a political beast. I was lecturing on that, I think it was last night. He has a political audience. How does he parse a growth recession, 0 to 1.x% versus a real recession? How does he do that politically in this press conference?
Well, I think what's been really unusual about this year is the way that both sides of the aisle have supported tighter monetary policy and supported aggressive anti-inflation policies. That, when you look back historically, is pretty unusual. So he's almost got a free pass this year to go aggressively like they did last meeting, like they're going to do in a couple minutes. Going forward, if we do actually genuinely have contraction in employment, that will be a trickier situation. Fortunately for Chair Powell, he has another 3 years on his term, but that's when things get interesting. But I do think we shouldn't lose sight of the fact that, he's basically got a political green light to be pretty aggressive this year, and that's going to continue until we see employment contract.
Michael Feroli, at this moment, using this fancy pants word from Booth School, Chicago, are we unanchored?
I don't think so. So if we're talking about inflation expectations, most of the measures we see, certainly the market-based measures, the market is, to Priya's earlier point, convinced that, or not convinced, but seems to be aligned with the view that the Fed will get things under control. And even if you look at, somewhat surprisingly, the survey-based measures are actually came down quite nicely in the most recent meeting. So I think fears about being unanchored right now don't, to me, that doesn't ring true.
So perhaps that's not ringing true just yet to you as well as the rest of the market. But Priya, I'd love you to come in on this. There seems to be this belief that the Fed will not have to stay at a very high rate for a very long time. Do you think that that's going to be what's required, a la Alan Ruskin of Deutsche Bank, in order to get inflation under control, in order to get the long end where you see it as you go and you buy 30-year bonds?
I think so. I think, there's parts of inflation that can come off, headline inflation. There's other parts like shelter that tend to be a lot more persistent. There are lags between home prices and rents and shelter inflation. And those lags will keep core inflation high. And so this idea that the Fed can pivot and go from hiking, to cutting quickly will require inflation to suddenly decelerate. And there are parts of inflation that I think are not transitory at all. And that will require the Fed to stay there. And that's when I think we'll all fret about the economy. But the Fed will say we've got a dual mandate and inflation is much too high. So we expect them to stay at these uncomfortably restrictive rate levels and QT for much of next year until inflation comes down and allows them that policy space to start to cut rates.
And Michael Feroli, there's a question embedded in that, which is what metrics the Fed will be looking at to know that they can reach an all clear, where they can start taking their foot off of the brakes of the economy. Is it inflation rate that falls down to 5%, 4%, or is it just an economic downturn that is severe enough that needs their support? What's your view on that?
I mean, clearly inflation numbers are going to be first and foremost. I think we can look at them on a sequential basis. It doesn't have to be on a year-ago basis. I do think they might be a little bit forward-looking as well. I mean, they haven't been forward-looking so far in this cycle. But I think if we see wages and wage growth really come off in a big way, that particularly if that happens in the midst of a recession, I think that would be a signal that some of the wage price spiral concerns would be easing. So I do think some of these supplementary measures will also come into focus.
Dr. Ferroli, a question in honor of the great Alan Meltzer. He once tore me to shreds and told me you can't partition monetary analysis, you have to look in the aggregate. Are we executing Fed policy for all of this nation or for one part of two Americas?
I think it's for all of this nation. I mean, certainly the price measures that we look at aren't disaggregated among buckets of consumption patterns. So some people would, certainly during QE periods when, criticize the Fed for setting policy for one aggregate, but that's,
right.
They only have the tools really to affect the aggregate and not to affect sectoral composition.
Michael, Priya Misra's adamant we should not mention September, so let's do that right now. And with you, Michael Ferroli, suggest what is the ghost or the shadow that September places upon this meeting?
So I guess one thing I would say is, last couple of meetings, Chair Powell gave pretty explicit meeting ahead guidance and quantitative guidance. I think he may stay away from that in this meeting because, as John mentioned earlier, we do get two sets of payrolls, we get two sets of CPIs, so a lot could change between now and September. I don't think the chair wants to be that definitive on what to look for in September. That said, I think unlike Europe, unlike the ECB, we will have some forward guidance in the statement, and that it will continue to indicate that further increases are, what's in the committee's mind right now.
Mike Ferroli, awesome to catch up with you, sir. As always, from JP Morgan to Priya Misra of TD, thank you to you as well. Tom, two things here. Lisa's mentioned this a few times over the last week. It's going to be really difficult to acknowledge the weakness in the economy that's emerging without implying that we're about to slow down rate hikes at a time when inflation still has a 9 handle.
Well, yeah.
That's going to be really, really difficult to do. Point one. Point two, to Mike Ferroli's point on forward guidance, Tom, what forward guidance can they offer today when they've got two more prints on CPI, two more prints on the labour market? That's difficult to do.
I mean, you're setting me up with this, John. I don't know.
Well, I think we've got Jackson Hole as well. There's plenty of opportunities to offer some guidance into September with a bit more data behind it.
With more data. They are massively data dependent, and this goes to ex ante, ex post, and the answer is all central banks, particularly Christine Lagarde with the challenges of war and what nat gas has done in the Netherlands, what you've chronicled, John, here in the last number of days. And differently, Jerome Powell, I'm sorry, they're massively, massively exposed right now. They're slaves to the data.
And they're explicit, Lisa, about getting back to 2. And at the moment, we're at 9.
Yeah.
We've got to remember that going into this news conference, into this statement 2 minutes away, we're at 9%. And we've just had a pretty hot inflation report that should shape this decision.
They have a long way to go, and it's only getting further away if you take a look at where we were on the last print. There are two debates here, and perhaps the most instructive thing that I'm looking for from Fed Chair Jay Powell today is the balance of risks. Is it a greater risk of inflation expectations becoming unmoored, or a greater risk of a recession so deep that it will be difficult to climb out of? So far, it has been inflation becoming unmoored. When does that rhetoric shift as we start to see some of the weakening in the data?
John, I'm not publishing this afternoon, but let me go 3-part on you. There's 9% down to, say, 7, and then there's 7% down to whatever, 5 or 4. How do we get, John, after all we've been through, from 4.8% down to 2.x%? What is the debate going to be, John, in a number of years, maybe 5 quarters? What's the debate going to be about 2 or 2.5 or 3? That's going to be extraordinary.
Well, Tom, I think that's the point that Alan Ruskin is making over at Deutsche Bank, that if they pause anytime soon, they could be staying there for quite a while, TK. They could be there for quite a while. This idea we transition straight into cuts, I've heard a lot of people push back against that this week.
Yeah, just, and this is off topic here, but I'm going to go there, John. No one's modeling stronger dollar. They're modeling resilient dollar. What if we get stronger dollar, particularly given the Lupton-Kasman note that they just published at JP Morgan?
Well, I can tell you some corporations, Bramo, they might not be modeling it, they're fearing it.
They're living
at the moment based on the earnings, and to Tom's point, they're living it.
Yeah, billions of dollars of lost revenues as a result of the strong dollar. At what point does that become a headwind to growth? At what point does that become a problem for the Fed? It's too soon, but it seems like the dollar versus what? Is this a euro story or is this a dollar story?
We are about 30 seconds away from that Fed decision. Let me guide you through the markets going into that. We'll start with the equity board. We've got a lift, a rally going into this Fed decision. Equities up by 1.3% on the S&P 500, up by 2.7 on the NASDAQ 100. The bond market shaping up as follows. Yields on a 10 10-year lower by 6 basis points, on a 2-year unchanged. That curve inversion there for all to see as we go into this decision, looking for something like 75 basis points with the decision down in D.C. Here's Mike McKee.
Well, status quo pretty much as expected. The committee raises the target range for the federal funds rate to between 2.25% and 2.5%, 75 basis points, and says that they anticipate, quote, that ongoing increases in the target range will be appropriate. There are very few changes in the statement. The only one of substance is an acknowledgement that, quote, recent indicators of spending and production have softened. Nevertheless, job gains have been robust. Inflation remains elevated, which they blame on the pandemic, broad price pressures, and higher food and energy prices, and of course, Russia's war on Ukraine, which the committee says is, quote, creating additional upward pressure on inflation and weighing on global economic activity. As they said in their last statement, the committee emphasizes they are, quote, highly attentive to inflation risks and, quote, strongly committed to returning inflation to its 2% target. As for QT, the committee reaffirmed its plans to raise the caps on roll-off of MBS and Treasury securities to $95 billion in September as planned. The vote was unanimous. Esther George did not dissent. Michael Barr and Susan Collins casting their first votes on the committee with the majority. Guys?
Michael McKee, you are going to be in the press conference. We know you're going to get the last question. They're so afraid of you. So let me avoid the question and ask you simply, what does he not want to say about September's meeting?
He does not want to say how much they're going to raise rates. I think he will, because the committee statement says they anticipate further rate increases. I think he'll endorse that. But he won't want to say by how much, because they're going to want to see what happens with the numbers between now and then. We get GDP tomorrow. We'll see how growth is going. And then you've got a couple of CPI reports and a PCE inflation report and 2 jobs numbers before the next meeting. It's an unusually long period of 7 weeks. So a lot of data that could change a lot of minds, and it wouldn't do the markets any good to get whipsawed.
Hey, Mike, awesome to catch up with you, buddy. As always, Mike McKee down in Washington, getting ready to go into that news conference. 75 basis point hike. We anticipated that. Lisa, we asked about how you would acknowledge the weakness. This is how they do it. It's in the first line of the statement. Recent indicators of spending and production have softened. Then you add this. Nonetheless, job gains have been robust in recent months, and that's what they're pointed to. That's where the resilience is, the strength at the moment at least. Lisa, we're seeing just maybe the smallest of cracks in the last 3 weeks with claims starting to pick up, but that's a nod to the payrolls growth we've had over the last few months.
And it reiterates what Janet Yellen was saying, the Treasury Secretary, where she was really emphasizing that strong labor market. How much are they going to use that as the reason to keep going? And at what point does this actually mean if we start to see real softening? We'll have a different conversation at the Federal Reserve.
And no big change in this equity market off the back of it. We're still positive by 1.5% on the S&P, on the NASDAQ up by 2.6%. If you look at bond yields, basically where we were, down about 5 or 6 basis points on a 10-year to 275.21. Pleased to say that joining us now is Mohammed Al-Arian, Bloomberg opinion contributor and chief economic advisor over at Allianz. Mohammed, you've had a few minutes to digest this. Your response, please.
Exactly as expected. The statement was very much what the market was looking for, and that's why the market reaction has been muted. The press conference, John, is going to be absolutely key, because I suspect that Chair Powell will be pushed on guidance, and that's where things get really tricky quickly.
How do you expect he's going to navigate that, Mohammed, given that we've got 2 more CPI prints, 2 more payrolls prints, and a Jackson Hole before we get to September?
I know how I would navigate it, or suggest to him to navigate. I don't know what he'll do, is don't be specific. Just keep it general. There's a lot of uncertainty ahead of you. As you point out, we have many data points. We have a major confab coming up at the end of August. Just keep your options open. That's what he should do. But in the past, he has been tempted to over-specify his forward guidance. So that's going to be key to see where he ends up this time.
How is he going to discuss, or how would you discuss, if you were Fed chair right now, the labor market? It is strong now. When does a weakening potentially trigger a shift in Fed policy?
So, Lisa, you picked up the one opening I see in the statement, and we'll see what happens in the press conference, is that now we need to, again, look really carefully at the labor market statistics, because they've countered all the other indications of weakening, and the economy is weakening, by saying, but look at the labor market issue. So we're going to spend a lot on every labor market report and a lot of time on, is it demand or is it supply? But that's where the next analytical focus is going to be, given their statement.
And what does it mean? How does it translate into Fed policy in terms of what kind of pivot it could bring? Is it a pause? Do you believe in the Alan Ruskin school of thought of Deutsche Bank that the Fed is going to reach the peak rate, its terminal rate, and it's going to stay there for probably 7, 8, 9 or more months as it tries to get inflation under control?
The answer would be easy if the Fed wasn't so late, if its forward guidance wasn't so damaged. In a world where the Fed had avoided these policy mistakes, they would pivot pretty quickly to the real economy. But in this world, where they have to restore their inflation credentials, that pivot is really tricky. So I don't think the pivot will occur as soon as some people are hoping for. And if it occurs, there's going to be a lot of questions about, is this the stop-go Fed of the 1970s?
Mohammed, that's right where I wanted to go, and I'm going to go all Frank Ramsey on you and your classic statement of T decision. They have a T decision off ISLM theory, which is the financial system and the real economy. I would suggest they're massively constrained by the real economy. How does he deal with that as chairman of the Fed?
You're absolutely right, Tom. Again, if he hadn't been so late in acknowledging the inflation issue, and if they hadn't been so late in acting, he would pivot. He would pivot as early as this meeting. But he's got to deal with the legacy of the policy mistake. So, it's a really tricky situation to be in, and I don't think there is a first best. I think he's got to assess the balance of risk. But the worst thing would be to end up in the muddled middle, because then you risk a lot of scenarios that are very unpleasant.
So as I said to Michael Feroli earlier, Dr. El-Arian, is this a Fed that is either unanchored or is theoretically unanchored because they have to wait on the real economy before they fix inflation?
It's a Fed that needs to re-anchor itself, but the real economy is again running ahead of it. So last year, the story of last year was the Fed lagging the inflationary realities. I worry that the story of this year will be the Fed lagging the economic weakening.
Exactly. Yeah.
You're going to build on that, Tom?
No, I'm not going to build on it.
Just cut Mohammed off, so I was just wondering if you would.
No, but this is really interesting asymmetries across the ISLM framework, John.
Stop cutting off our guests. Can we just stop cutting off our guests?
I'm not cutting him off. I think he's brilliant. Continue, John.
Mohammed, can you tell me year end then, do you think this Fed has to tolerate higher inflation to support growth? Is that what leads you to believe? Do we get the flip-flop?
John, look, I don't know. These are decisions that are yet to be made. If you put a gun to my head right now and say, what's the most likely outcome? I would say it's equal between this Fed remaining committed to restoring its inflation credentials and therefore causing undue damage to the economy, and the stop-go, the flip-flopping Fed. There is no good outcome in all this. That is why it has distressed so many of us that fundamentally support the Fed and know how important it is to the well-being of the economy. That's why we were so distressed by how far they're falling behind. It's because you take away first best policy options, and then life gets a lot more complicated, as we see today.
You wrote a scathing piece in Bloomberg Opinion over the last week, Mohammed. I'm going to share some of it with our audience, and you talked about the deficiencies this Federal Reserve needed to address, and that if they didn't address it, they would be remembered by economic historians as having unnecessarily caused the US recession, having destabilized the global economy, still trying to recover from COVID, having worsened inequality, having fueled unsettling financial instability, and having contributed to debt stress in fragile developing countries. Do you put the Fed at the top of the pile, Mohammed, for all those things?
That is the risk. And as I stressed in that piece, John, it's not preordained. The Fed, with the help of other agencies, can avoid that outcome. But it has to address its four major failures, One of analysis. It's gotten the inflation analysis completely wrong. 2, forecasts. John, when you have people coming on your show, former Fed official, who call the Fed forecast laughable, you know you have a problem, okay? Most economists have dismissed the Fed forecast even before the ink was dry. The third problem they've got to do better is act more quickly and finally communicate better. Those are, I think, well-agreed failures that they can and should address, and they need the help of other agencies to avoid this. None of this is preordained. We just need a step improvement in policymaking.
Mohammed, I'm trying to think about the situation that you've laid out about weakening growth, a Fed that's still hiking, the stop-and-go Fed as they deal with weakness and inflation that still is higher than that 2% mandate. What does that do to the dollar?
So the minute you take me to the dollar, Lisa, you take me to the compare and contrast with other countries and the image of the cleanest dirty shirt. We are the cleanest dirty shirt. That explains dollar strength. We have interest rate differentials in our favor. We have growth differentials in our favor. And we have the flight to safety in our favor. So I am not in the camp, and I haven't been in the camp, and you all know this, for years now, fading the dollar. No, the dollar will continue to strengthen from now. That's good news for the US because it reduces the imported component of inflation. It's less good news for the rest of the world. The pivot by the Swiss National Bank to targeting a stronger franc as opposed to a weaker franc tells you of how important this reverse currency war has become.
It's a pretty dire future, and a lot of people are looking and trying to understand the stop and go, the exit strategy for a Fed that finds itself in a bad situation. Diane Swank, also here on deck, chief economist at KPMG. Diane, what do you think of what Mohammed was just talking about in terms of there are no real good options and they're facing a potentially curtailing an economy, lagging behind weakening data at a time when they still have to fight inflation?
Well, I think I know Mohammed well, and I think the world of him, and I agree with them that the Fed is now between, or the economy and the Fed, having been a part of that, is now between the proverbial rock and a hard place. There's no way to extricate ourselves without there being some pain, and I think that's very important. I think the Fed understands that, and their focus is now in restoring their inflation-fighting credibility, and their focus is squarely on inflation. They're no longer resting on the laurels of the supply side coming up to meet demand. Instead, they're hammering demand to bring down to a supply-constrained world, and what I think that means is one of the outcomes that Mohammed talks about is higher unemployment and, in fact, a recession. The problem is, and I agree with Mohammed on this, the Fed can't calibrate. They don't have the precision to calibrate the next recession. They can't just say it's going to be a mild recession and all is done. And their worst nightmare is hitting that tripwire we've talked about before that Mohammed also alluded to, and that is, the ultra-low rate environment of many years embedded a lot of sins in the global economy and in debt overall. Raising rates reveals those sins, and in doing so, you could hit a tripwire that triggers a credit market crisis and a much deeper recession that is harder to extract yourself out of, or the Fed has to intervene before it's really beaten down and derailed what is a more entrenched inflation. And that's a very different situation than they had in the early 1980s when Paul Volcker broke the back of inflation. And here they are trying to not repeat the mistakes of the 1970s, but in a much more complex context of a more connected global environment.
Diane Swank, Brad Hirschbein out of a small school in Ann Arbor, Michigan, is absolutely brilliant at partitioning the middle class of America. Who is Jerome Powell speaking to today? Is he prosecuting Fed policy for the elites and placing the middle class flat on their back?
You know, I think this Fed chairman has been very good about trying to be much more approachable and much less pedantic in addressing the broader public, and I think that's important. He's also been, I give him a little more credit than Mohammed does in terms of being vague. He has been an artful dodger at times, and I think that's the Fed chairman you're going to see come out today in terms of commitments to the size of future rate hikes given the uncertainty we see. But I think he really needs to speak to the middle class. He needs to speak to those who are hit hardest by inflation, and talking about it in the sense of what we're risking here is a multi-year erosion in living standards that could become, you know, decade-long erosion in living standards and a more vicious cycle of falling profit margins and layoffs. That is a worse outcome than the counterfactual, which is, this is the nuance, this is how it's hard to explain, than taking an upfront rise in unemployment today. The key is how much of an increase in unemployment. You know, our own estimates are higher than those within the Fed system, or at least what they're willing to publicly admit, and that is that we need to see at least a 5.5% unemployment rate sustained to get inflation down to the Fed's 2% target. And you talked earlier about whether or not the Fed, you know, stops before 2. I don't think they can afford to stop before they get inflation really going towards 2%, because they've already risking that, you know, unmooring of inflation expectations, and they don't want to repeat that mistake.
A lot of people share that view. Mohammed, I know you're pushed for time. You've been gracious with it with us. You've got 1 minute left. Can you just tell me what you want from this news conference, what you'd like to hear from Chairman Powell?
So I'd like to hear a bit of Andrew Bailey, in the sense of doing exactly what Diane just said, explain to America that this is not a perfect world, that there is cost in the approach being taken, but that is better than the alternative. I think honesty in communication and stepping away, to use the phrase in Britain, of fairy tale economics is really important. And then I'd like also an acknowledgement of how they've improved their forecasting abilities so that they can restore the power of forward guidance. That's critical to their success, and we all want them to succeed.
You've got 5 seconds left to tell me whether you think we get that at 2:30.
I'll wait and see, John.
Hey, Mohammed, wonderful to catch up, sir. As always, Mohammed Al-Arian there. If you're just tuning in on TV and radio, we have Diane Swank of KPMG with us, running us into the news conference with Chairman Powell in about 13 minutes' time. If you're just tuning in, you missed the 75 basis point hike by this Federal Reserve. No big changes to the statement. They do acknowledge some of the weakness out there. In the first line of the statement, they say recent indicators of spending and production have softened. They go on to say that nonetheless, job gains have been robust in recent months and the unemployment rate has remained low. Going into GDP tomorrow, the commitment is all about inflation again. This line in the third paragraph is still there. The committee is strongly committed to returning inflation to hit its 2% objective. That news conference starts in 13 minutes. Going into it, Lisa, just looking at the price action, still elevated here on the S&P up 1.4%, on the NASDAQ up by 2.65%. The tone is going to be shaped by what happens at this news conference, because I have to say, Brahma, there's not much to go on in that statement.
Yeah, status quo right now, and that's basically how it's being treated. Although status quo is interesting when you take a look at the bond market, when you take a look at the yield curve, and Tom was talking about this earlier, you were talking about, Priya Misra was talking about a 40 basis point inversion in that 210 spread. We are getting there quickly. It is now in excess of 30 basis points. It is the most inverted going back to the year 2000, at a time when people are already plotting how the Fed is going to respond to the recession that inevitably ensues. And that seems to be the theme and what people are doubling down on right now in markets.
TK, you've been great about this over the last few weeks, the long road to the September meeting. And we've said it repeatedly over the last hour. We've still got 2 more CPI prints. We've still got 2 more labor market reports.
Yeah, let me get out those exact dates, September 21. And John, let us not forget November 2nd as well. And it's going to be the CPI reports and the makeup of it. And it's about goods dynamic. Will it go back and somehow disinflate back near zero or even true deflation in goods? And what's really interesting, not addressed by Joseph Lupton and Bruce Kasman in their note of an hour ago, is service sector inflation in America, which is a sort of kind of like lift, John. Do we see that ebb away and roll over? That would be the best news from Jerome Powell.
So there are 2 CPI reports, Tom. I understand they're August 10th and September 13th. Mike McKee mentioned something that's really important. The September 13th CPI print for this Fed falls in their quiet period ahead of the September 21 meeting. There are other avenues, I understand, TK. If you want to talk to a journalist over at the Wall Street Journal and tell him what your intentions are after that print, there will be plenty of opportunities for this chairman to set up expectations in September if he doesn't want to do it today.
I would put less weight on forward guidance, and all those jawboning and speeches and all the rest of the media song and dance is that. It's forward guidance. These people are thunderstruck given a pandemic, given the horrific cards they were given, the huge fiscal stimulus, and they're going to wait for the data. And I think surveillance has said that all along for quarters.
Hey, Tom, you've said it repeatedly.
I don't see it
I've said
any
go
other way.
back to the December meeting, December of 2021,
Yeah, John.
and just look at where they thought rates would be for this year. 0.9% year end in 22. Lisa, we just had a 75 basis point rate hike.
Yeah.
That's how wrong they were about the future back in December, and here we are in July.
Which data do you watch? And that, I think, has been the key. Are we now watching the University of Michigan inflation expectations? It seems like that perhaps is fading. Is it the employment cost index, which we get on Friday? Is it going to be now the jobs market? Are we going to be watching how much unemployment is ticking up, how much the jobless claims are just ratcheting up just slightly? How much is that going to become the new metric? But this is the key issue.
Yeah.
What data are they watching? What are the parameters of risk that they're measuring? Because that is what the market is trying to do.
Right now, they can tell us it's CPI. It gets difficult when the two sides of the mandate look like they're in conflict with each other in a more obvious way. And Diane Swonk, thank you for being so patient with us from KPMG. She's still with us. Dan, do you think by September we could have the two sides of the mandate more in conflict with each other? Unemployment going in the wrong direction, CPI still elevated?
I think we're going to have CPI still elevated. I don't think we'll have enough of a move in the unemployment rate by that point in time for the Fed to feel that it's in conflict, and that's the key. Remember, we need to see about a 0.5% move over 3 months, which I do think we'll see as we move into the end of the year and into 2023 to sort of call it a recession, and then it's going to go higher than that. But at the moment, I think we've still got a window of period where you're going to see some cooler inflation numbers from the fall in prices at the pump, from some of the commodity prices coming off their highs. But the Fed has really made clear it's no longer willing to rest their laurels on that. You've heard the big box discounters wanting to discount more now. Actually, instead of raising prices, that'll help a little on goods inflation. Interesting, though, in today's manufacturing inventories, they are not where the overhang is. Retail inventories are up, but manufacturing inventories are not. Vehicle prices were still going up in the month of June, both new and used vehicle prices. Those are the things we thought would be cooling off now. And as Tom said, the service sector inflation, the bulk of the effect of higher home ownership costs and rental costs, which are skyrocketing, are still ahead of us. And the shoe to drop in medical cost has only begun to drop. Those are things in core inflation that the Fed cares about, they can do something about, and they're going to have to battle. So even as we take the steam off of these numbers, there's still going to be the lingering inflation that they're going to have to deal with. And that's where it gets really tough to get inflation from here down to a core level of 6 or so, down to a core level of 4%. Not as hard as getting it down to that 2 to 2.25%.
Dan, we don't get forecasts this time around. We get them next time around. Last time around, you had plenty to say, and the time before that as well. I think you called them fanciful. Can I go back over them again,
yes,
please?
Yes, I did. I think I called them fanciful.
You did. 2022 GDP, they've got it at 1.7. Core PCE at 4.3. Unemployment at 3.7. 2023, 1.7 on real GDP, 2.7 on core PCE, 3.9 on unemployment. If you could give that a refresh right now, Diane, just directionally, if you can't give me numbers, what would it look like?
Oh, we're going to have much lower GDP. I mean, that's going to be negative couple tenths% at least, and that's the good scenario because we started off the year with 2 negative quarters. And we're going to be stalling out as we go into the second half of the year. The housing, we had 20% down on pending home sales today. Housing is the canary in the coal mine. It's not singing anymore. And yet prices are still rising because of supply shortages. So I think these are the issues, the struggle the Fed has to deal with on rate hikes. I think they end at 4% with the reductions in the balance sheet amplifying the tightening. What I'm really worried about is that no one, including members of the Fed, knows how much the runoff in their balance sheet will actually tighten credit markets.
Diane, I want to go to your wheelhouse as seen by your work with the National Association for Business Economics. We mentioned housing earlier. You mentioned it as well. I don't buy for a minute that home ownership is separate from renting. To me, they're inextricably entwined. And if we do see a housing market slowdown, doesn't that by definition look for a rent lift, which will still imply housing inflation?
Absolutely, and that's one of the problems right now, and that is one of the challenges we face. We've got a decades-long problem in undersupplying affordable housing in this country, and that's traced to a lot of regulatory issues at the state and local level, zoning, not in my backyard issues, all kinds of factors feeding into that, a decades-long problem. That said, you know, it'd be nice if we were actually building homes right now. Even though builders don't want to build homes right now because they can't get the profits they once did on them, and with rising rates, the demand isn't there. But affordable homes would be nice to be building when the economy is actually, you know, slowing down and the housing market is actually correcting. That's not what we're going to be doing, and you're absolutely right. What I worry about most, Tom, and this gets back to the other issue you asked me about before on who are they talking to, the rise in homelessness among the working poor. We had that prior to the pandemic. We had it during the pandemic, we got a break, and now it's coming back, even at 3.6% unemployment. And that is something that is really hard.
The saving grace of America, and including starkly separate from Europe, has been the technology overlay. Think the land of the laureate, Paul Romer. Do you have a confidence the technology overlay is still there to bail out good citizens like Jerome Powell?
You know, I don't see the productivity growth right now that we'd like to see, and one of the issues that we're seeing with that Jay is facing in the labor market is sort of the elephant in the room is COVID's still with us. In the month of June, the number of people who are out sick, adding to staffing shortages and unable to work, was 55% higher than it was in any given month prior to the pandemic. So you've got that issue still out there when you've got long COVID as well, taking people out of the supply of the labor market. And then we layer in all of the supply issues with regard to, immigration, the loss in education that we had due to the pandemic, and the pivot to online schooling, all of those things together, and then the aging of demographics, you need a lot of technology, you need a lot of productivity growth to offset the inflationary pressures coming from our own labor market, and allowing people to have real wage gains, not wage gains that disappear and are disintegrated by burning inflation.
Diane, awesome, as always. One of the best. Diane Swank there of KPMG going into the Fed decision and the news conference. The news conference 3 minutes away. At the other side, we'll catch up with Mr. Rosenberg of BlackRock and Mr. Dudley, formerly of the New York Fed. I imagine Dudley's got a lot to say about this particular decision and the news conference still to come, Lisa, because he's of the opinion that this Fed might have to go higher, much, much further than many people are discussing.
Yeah, he and Mohamed El-Erian have had a lot of agreement, and the rock and hard place is something that Bill Dudley has been talking about and hasn't talked about the rock as much as they have to, and the hard place that we're going. I just want to bring you this. A number of commentators, a number of listeners have been writing in, including Kit Jukes, talking about which data is going to be important. He says jobs, jobs, and jobs. August jobs figures are going to decide how aggressive they need to be in September. How much are we going to be watching those claims, watching the unemployment figure?
Claims have been climbing the last 3 weeks. And this was always going to be the problem when you try and acknowledge the weakness. And then you mention where the strength is, the job gains. For the market, that starts to become a target. And they're going to try and weigh that up against what's happening with inflation, Tom. That's why this news conference is so important. We're not looking for him to say 50 in September, 75 in September. He might do that, I have no idea. But we're not looking for that. We want a deeper understanding of the Fed's reaction function, how the data will shape their next move. And Tom, this chairman's got to do a better job, I think, of that, because it's been missing over the last year or so.
To me, it's partitions of data, John. Is one of the themes we've had here from Michael Ferroli on this afternoon. Frankly, we can take it back to the morning show as well. Is it's not just about inflation. It's the dynamic of service sector inflation with goods inflation. David Rosenberg and Bill Dudley are miles apart in terms of the partitions of just service sector and goods dynamics. And you're going to see that across every nuance of this press conference. He's got to bring out some of those nuances and not just the numbers at 60,000 feet.
Yeah, Lisa, that was the problem with the 9 handle on CPI. When you strip it back, there was something there for everyone. The people who say inflation's peaked, commodities are coming back down, and the people who say, look at shelter, this is going to be sticky, be stickier, it's broader, it's going to be with us for longer.
Although
Which two camps?
Right. Although the Fed last meeting said that they are not going to be too nuanced about this. 9.1 is just too high. Do they become more nuanced as employment rates go up? I think that's going to be an interesting discussion, especially as you see the yield curve continue to invert.
What have you said over the last week in that promo? A sledgehammer. A sledgehammer over inflation.
Yeah, I love that. I love that.
Something like that.
I said that? Well, no, they want to take a sledgehammer to inflation. Can they? Right now, it's not theirs to take because they are dealing with supply side issues. They're dealing with so many multifaceted disruptions from the pandemic. Tough situation.
There we go. That's the Abramovich.
That is the Bramo take, but that's what I enjoyed, Tom. That's what I'm here for. That's why I'm staying late. Not to hear Chairman Powell. I want to hear from Bramo. As everyone else does. The equity market.
Joining us now at our press conference, Michael McKee with a question. Bramo, Michael McKee from Bloomberg.
Your equity market right now at 1.5% on the S&P and the Nasdaq up by 2.9. I'd love to get Bramo in that news conference. When I was at the Bank of England news conference and the ECB, I was way too polite. I'd just like to see Bramo go in there and just, why aren't rates at 5%?
Oh, here he comes now.
The chairman's in the room, stepping up to the podium. Here's Chairman Powell.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Rachel? Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from The Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular?
And given that potential tension and signs of, any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 2.25 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jarrell. Thanks for taking our questions. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both. And we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level, ultimately, at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions. And those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi,
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be, they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really created a very strong and robust set of rules that will support public trust in the institution, and again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katerina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates, and, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases, and now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully, and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there's a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter. But at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole. Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So, executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID and that there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment. So I think we're going to be looking at inflation as well. We you know, as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot of
forecasts? How did bank forecasts of possible recessions economies? Does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event, given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment, as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now, and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. And I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time, it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Chairman Powell, Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we'd like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation. But I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately, the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all those decisions? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And, when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And, our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time, and so that's really what accounts for the pace at which we moved. And we did when inflation changed direction really in October. We've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month, and we kind of thought we had the story, probably had the story right. But then I think in October you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted, and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Thank you very much. Simon Rabinovich with The Economist. You've said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that NAIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NAIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for the negative slack we have in the economy by the overtight labor market. So if you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now, and I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. You know, going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that while that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. From a financial stability perspective, you know, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets. And so you have a pretty, from a financial stability standpoint, you have a pretty decent picture. Now, macroeconomic, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, you know, we think of that as things that might undermine the working of the financial system, so big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering